boys and girls. We back once again with some more analysis, market analysis, overall analysis. So if you're interested in sticking around for this video, I've been doing several videos here detailing what I think the probabilities of the market doing stuff, moving in a direction are. And they've been working out really well. So if you want to see the process on how to predict the markets and set up a nice trade for yourself, at least for futures anyways, or SPY calls and puts and that kind of stuff, stick around. If you're not interested in that kind of thing, obviously check out some of my other videos with some really nice chart layouts and other tips and tricks on how to read options, premiums, and that kind of stuff. So without further ado, let's get into the method of the madness here. And so what we use here is if you've never heard of Gregory Mannarino, a big YouTuber here that has been calling the markets pretty spot on for a long time, many years that I've been following him. He came up with this risk indicator called the Mannarino Market Risk Indicator, which is kind of long. So it's just the NMRI. What it does is takes the US 10-year and the Dixie, which is the dollar index, the relative value of the dollar, and divides it by 1.61. Don't ask me why he uses that, but anyways, he does. And he says this is the best indicator that he's ever found that will tell you whether it's your risk on or risk off environment, or where you're at there. So we've been tracking this last couple of days since I've been doing these videos, and looking at the number here. So between 50 and 400, 50 being the least, 400 being the most risky. We've been tracking here in the high 80s and mid 90s. So today was a 95, which means, basically it was flat. So we had a nice move higher, yet we had a flat move. Yesterday was a nice move higher, and we had a flat move. So we're trending flat on the risk, and we're moving up in the markets. And so that's interesting to me. It's just a small, tiny little detail of divergence. So I'm not going to think about it too much, but right now it's just not risky to hold stocks. It's basically what this is telling me for now. And the other method I use, I don't know if you ever heard, there's another YouTube video channel, another YouTube channel on that I followed for a long time, for many years. And it's called 13 Market Moves. So check it out. It's really interesting. Don't buy the course, because I'm going to teach you all this stuff here for free. Just don't tell anybody, and eventually we'll get to all the different types of moves and stuff. But the general thesis is that there's only 13 types of moves in the market, and you can start using, if you can identify the moves that happen during the day, you can use that into a sequence or a pattern to basically give you a really nice timing model for day trading. And that's what I do, is I day trade futures and options. So most of you guys probably do too, or are starting out. And so this is going to give you a really nice kind of a base layer, simple base layer for engaging risk environment using the US 10-year and the dollar, and also timing the market, knowing the times of days, knowing what type of move can happen, and when the dips are going to happen, whether a gap up or gap down matters or not, and using that as your day trading indicator in conjunction with really solid levels. That's the next thing too, is knowing what levels to buy. And I'm a big proponent. You'll see a lot of videos on my channel that have a lot of different fancy indicators, super trends, moving average ribbons, what else do I use? I mean, Ichimoku clouds and stuff. I don't actually use any of that stuff. I just think it's fun to kind of mess around with. And I like creating different layouts just for fun, because I'm kind of a nerd. But, I really don't use any of that stuff. I basically just use open, high, lows, and closes. And that's it. Just, all those other indicators, they are just derivatives of open, high, lows, and closes in general, unless it's a volume-based indicator, which I would be a good proponent of, is volume-based indicators. But if you're not using volume-based indicators, you're using price action, then open, high, lows, closes of the days, weeks, months, those are the levels that you if you're intraday trading, those are the levels you care about the most. So that's all I use. And I'll show you guys a trade that I did today that's exactly what I'm talking about here. So it worked out perfectly. Anyways, so the patterns of the 13 different types of moves that can happen, some of them are bullish and some of them are bearish, and some of them are different degrees of each. In this case, we've got just since I've been tracking this for the videos, it's been all bullish. Every day has been a bullish pattern. So a 7, 1, 1, 13, 4, 7, 7 is an extremely bullish pattern and sequence, because you're developing this 7, 7 sequence here. You start getting those triple sevens, and you're starting to look. Now you're starting to look for some more ones. So I'm going to show you what a 1 is real quick here. The ones are really nice, because if you can catch the ones, nobody else really is ready for them, and 13s as well. So here's kind of how I track the market moves, and what I've been doing is tracking it since Fed Day, which was here. Fed Day, which basically usually starts a new trend for the market, and so if you watch the FOMC minutes, and when Powell talks, this time he didn't talk, but tracking that day, that usually kind of sends the market in a direction, unless they leave the market with mixed signals. But in this case, it was pretty clear what was going to happen, and so we're tracking the market from that day, and so we've been just tracking this trend all the way higher. And so what we want, a move 7 here, is a gap up, a dip, and then a rip, and it just kind of looks like this every single time. So that's a move 7 that happened, which was rare. That happened on FOMC day. That was rare. And then I add some anchored VWAPs on the highs and lows, so we can just kind of track the trend, just as a basically as support. If this gets broken, then we're obviously if we're breaking the support from the Fed day, then that's a pretty bearish situation. But we're more likely to buy that, buy those anchored VWAPs, at least initially. So anyways, what happened was the 7 created 2 move 1s in a row, which was a gap and go. That's a move 1. Okay, so that's what we like to see. We want to catch these gap and goes. If we have a good idea that it's going to be a move 1, everybody else is chasing in most cases. I would say the majority of people see the gap up, and what has been happening is the gap ups, and in a downtrend, gap ups are typically sold off, and yeah, I'm not trying to show you an example here because this is a really choppy area here, but in general, a gap up is going to be sold off. And so what most people do are they're liquidating their positions here, and then the market rips, and so then now they're chasing higher, and they're chasing higher, and bears keep thinking the drop is going to come, and it never does, or if it does, it's really small and it gets bought up again. So these move 1s are really nice. We want to be positioned for a move 1, either the prior day or at least have an idea that it's coming, and that usually comes after move 7s. Move 7s are the dip and then the rip. So and then it has to be a gap up. The next one is the move 13, which is a gap down, where they freak everybody out. So you had the 2 long drawn out buys, and then they gap it down, and then they buy the open, the gap down, they buy it super hard, and then rip it even higher. So a devastating short killer move that just happened off of that Fed day, where they hit you with the 7, the 1, 1, and then they drop it, bait the bears, and then rip them again, and then gap it up for another move 7. So you can see how the same thing, gap up, dip, move up, gap up, dip, move up. And then I call this a move 13 because they did that gap down again, bought the low, move up. We started running into all-time high levels, so the rip wasn't as stellar as it usually was back here, just because we were still coming off the event vol wind down. And that's kind of what was happening, was all the hedges and puts and stuff like that were just being offloaded, and that's what causes this move. And also short covering. There's a lot of shorts that come into the FOMC thinking that they're gonna raise rates or do something crazy. Powell's gonna die on stage or something, but that's what they're hoping for. It never happens. Anyway, so you're running into all-time highs. You can see it kind of getting petered out here as far as the rallies. And then you got here with a move 4, which is a little bit less of a move, that a little bit weaker of a bull move versus all these other ones. So I started getting a little weary here, this move 4, and into a Friday especially. And so, what was nice about knowing these patterns is that, I'm all bull here until I recognize the move four. The move four is the gap down, and it isn't. You got to kind of recognize the difference between the two. Whereas this one ripped, and the retest wasn't until the middle of the day, till they came back and retested the open. They tried to push it down, but it didn't even really come down. Here they retested the open, so that's what distinguishes the difference here. Both of them start with gap downs, but the four retests the open faster, early in the morning. And this happened here, this sell-off here was a tip-off for me too, that the move was, because usually a move 13, if it starts off like this, you're going to end up higher, like this one. This one ends up higher on the day. This one didn't, so this told me that the move was getting, they're almost invalidating the move with this midday sell-off, which didn't end up lower, so we're still in bullish patterns. But here we retested the open, which is another signal for me that things are getting weaker here in these 2 days. Even though we ended up higher, this ended up becoming a move forward, which is a weaker build move. So hopefully you're following me a little bit with these patterns. But this is basically how I track the track SPY anyways, or track ES. But I kind of just use this to play the futures or buy SPY options or whatever. And then so I kind of knew that a volatility event, I don't know how long it was going to last, but I figured a volatility event was coming. And then so then they hit us with this crazy move 7, which it still ended up being a move 7 because it was a gap up, it was a sell-off, and then they bought it. It was a weak move 7 because you can see this move 7 ended up higher. This move 7 ended up higher, and so this move 7 didn't even touch the open. So it was still a move 7, but it was a variation. So and it culminated with like a little mini head and shoulders there. So I was getting a little worried here, and then they came in and hit us with another move 7. So, and the only reason I figured it was a buy the dip situation was because they gapped it over. They gapped it over what they failed to finish on Friday, and so I gave them the benefit of the doubt. I gave bulls the benefit of the doubt on Friday because it was Friday, and Amazon was selling off. There was a little bit of a bearish tone happening just because it was an options expiration day. It wasn't like it was like triple witching or anything, but it's Friday, so Fridays are kind of you got to give some room for variability there. And so they didn't really get to finish what they started, and then they gapped it up. So I put these lines here on Friday, and so they gapped it up right above that trend line here that was created on Friday, and then retested it and bought it up for another move 7. So I was still, even though it was getting a little bearish because we were approaching all-time highs, we were still in this crazy bullish pattern, still above supports, and we gapped above a trend line. They don't really use trend lines too much, but I will in certain situations. We gapped above that. So coming into today, I had a really good feeling that we were probably gonna be in the buy the dips type of situation. So and that's exactly what happened. We came in and bought the previous close essentially. If you put a line right here, that's exactly the point they tried to bring it to. And so what that coincides with was this. I actually made a video that I didn't publish detailing my plan to buy this level early on because my prediction was that, and I'm not trying to toot my own horn, I'm just saying that this stuff works. My prediction was that they were going to, just because I've been watching it, they were going to melt this overnight futures up to create a gap up. And the reason they do this is because they're sick, twisted, evil fools and freaks. They create the gap up right above previous all-time highs because what's going to happen to the average retail investor if you give them a weekend and then you gap it up over previous all-time highs? What's the average person going to come into the market as soon as it opens and do? Well, they're going to come in and buy. They're going to come in and buy this because that's bullish. That's bullish that they open it. The market's opening above all-time highs. It is bullish. I agree. But what always happens, especially if you're anticipating these moves, if you always know that, if you know what's going to happen on the open is so key to telling what's going to happen in the rest of the day. The open and the retest, the opens and the closes are almost all that matters. Yeah, high of day is a thing. Some people play the high of day, but all I play off of is essentially, at least my first trade of the day is always going to be off the open or off the previous close, which is essentially not always the same. So, they're typically close, but not always the same. Anyways, I'm always expecting this early dip, especially in an uptrend, because one, they want to bait the retail player into buying that early dip or early gap up, creates liquidity for them to sell into. And then once early retail guy is out because he's going, oh man, they're selling it off on me again, then they buy it. And they typically buy it at a pretty logical level. So they brought this right down. As soon as I saw this selling off here, I'm preparing to buy this level. So I'm buying into this. And I'll buy here just a little bit early, just in case they didn't bring it down to this level. And then I buy again. I just keep buying until they're either able to break this level or until they rip it higher. And so I was anticipating a move 7 again, just because of where it opened, and based on this sequence here that we're super bullish. And then at the same time, I have a logical level here. So it all made sense that they would bring it up here, bait, sell it off into the logical level, and then rip it higher again. And that's exactly what they did. So they rip it higher. They rip it above previous all-time highs. And then by the time you know it, by the time you're here, the move is already over. Essentially, the move 7 has already been created. And the move is pretty much done, unless you want to try to play end of the day rip or something. But I don't do that anymore. I've lost way too much money trying to guess what's going to happen there. This is way more consistent, messing around with the open and understanding the open and the open movements. And that's where knowing the sequences are going to help you with that. Okay, so there'll be more teaching on that. But okay, so moving into tomorrow here, it looks like they're creating a little bit of a top here, which makes that coincides with SPY levels. And this video is getting really long. Hopefully you guys can stick around for a little bit longer, because we're going to go into how the SPY levels play into this. And SPY levels are really important, especially the 30,000 pluses. So if you don't have unusual whales, I would highly recommend at least getting I think there's just like a basic version for $30 a month where you can get all the flow after the fact, and tracking SPY levels, because these 30,000 premiums, there's a lot of money that come into these levels here, and they're going to actually break it out whether it's bullish or bearish. So you can start to develop a sense of what the market wants to do and where it wants to go and by when, based on these levels. And you can dig really deep into this too. You can break it down into, how much premium is going into 456 in what days. Okay, so are they targeting 1217 mostly, 1119, or is all 66 million premium for 456? Is it all for Friday? That would be pretty important to know if you were able to gauge where all that premium is for. Okay, if you do 66 million or say 60 million here of this premium was bullish for 1029, and only say 20 million of this premium was bearish for 1029, well, you have a huge divergence there, as far as a bullish divergence that's happening here, because for a specific date. So now you got a timing window and strike levels. So building a model here, you basically have a model here where you've got a market risk indicator, which uses extremely reliable indexes, and has a nice little number that it gives you. You have a risk on, risk off indicator for like an overall general market. You've got a timing indicator for the days. So now you can track a sequence of and you've whittled it down to 13 types of moves. So you can only expect a certain type of move based on the sequence and based on the gap ups and gap downs, and you just wait for the pattern to develop, and then you play the pattern, especially if you're really familiar with it. So you got the timing model for the day trade. You've got the overall general market, and then you've got options. You've got an options index, basically, that's going to give you a measure of the options activity that's happening. and it gives you an oscillator. So everybody uses an oscillator. I mean, in general, there's a few traders that don't, but everybody's using an oscillator. You're using an RSI, you're using the CCI, you're using Williams percentage R or whatever, or MACD. But I find this oscillator to be extremely helpful because it's tracking options quotes which have been flagged by the Unusual Whales algorithm. So if you guys don't know about the Unusual Whales bot, it's extremely helpful for finding unusual trades. Basically, it's a really nice filter to find unusual trades that are happening within all the different options chains across the market. So if you're able to put this into an index, which is what's happening here, it's extremely valuable because it's going to give you an oscillator based on the points. Okay, so you can see where you have really extreme oversold or overbought levels. And it's just one part of the toolkit here. So right now, as far as the reading goes, you have a 270. As far as the entire index, it's 270. Okay, so if we look, we actually have each stock up to 82 stocks here, which gives you their own personal reading. So all of these readings are going to factor into this overall index. So we have 270 points, but we have PayPal at 330. We have Tesla at 254, which is almost the entire index. Basically, the whole market today was like PayPal, as far as options, was PayPal and Tesla. As far as unusual trades, unusual options trades. Amazon had a big portion of that. And then the rest of the market was pretty garbage. You have Space sitting here at 694. And so you can use kind of like a relative gauge based on the index to see which stocks are kind of either, as far as unusual options activity, outperforming or underperforming. And so this is going to give you a nice indication of either the general overall market. You can start whittling down plays that you might be interested in doing for options. And if you see some crazy overbought or oversold reading, like a 10,000 overbought or a 16,000 oversold, well, that's going to give you a heads up as to, at least in the options market, what's going on. And then obviously looking at SPY flow, which we already kind of talked about a little bit, but looking at the different strikes and really focusing in on this 30,000 at least at first, because the rest of these guys are crazy. Okay, they're all over the place. The 15,000s, I pay attention to them too, but the 5,000s and 1,000s don't seem as important to me. I don't know. It's just me. There might be someone out there that goes, yeah, those are super important too. And the only reason I would say the thousands are important was because, I can see here that today, end of day, the 1,000 plus, between 1,000 and 5,000 premiums, we're buying 472s for SPY. Now, I could break this down. I could dig a little deeper to see, were they buying mostly 472s for 11.19, or are they buying mostly 472s for Wednesday? Okay, so that's some important information too. Is you got the 1,000s, basically lottoing money into way out of the money. This means SPX is 4,700 if SPY goes 470. Very unlikely. What's more likely is that you got 66 million premium in the 456 strike level with the big money. They're bullish, which is another thing too. Is the last like 9 days in a row have been bullish, and this has been red every day. All levels have been extremely red, and this is the first day I've seen it actually turn green. So turning green, technically it's a bullish indicator, but it's interesting that they finally turn it green on calls versus puts at all-time highs. So I find that interesting. I'm not sure if this is going to work as a contra indicator, where now all of a sudden we're bearish because everybody's bullish, but at least it's an options-driven market. So if we're bullish, we finally shaken off all the hedges, and then we might start seeing a melt up here. And so now we can see timing as well, 12/17, 11/19. So all the premiums being poured into these three different dates, and so that's going to kind of give me an idea of, a window of either bullishness or bearishness. And right now, based on putting all the information together, I would say we're still extremely bullish, and dips should be bought. Now I'm trying to short this here just because I know it's after hours and we've ripped up. My thesis is that we still go higher, and we probably break all-time highs again this week. But given the fact that SPY premiums are kind of concentrated in this level here, the 455s, like 458s, that's going to coincide with ES, basically where we're at right now. So I don't anticipate them being able to break above these levels in such a low volume environment. Maybe around 1 or 2 a.m. they'll be able to rip this back up again, but I imagine that they would want to open this up a little bit lower for the cash session. So that's kind of my thesis there. So anyways, hopefully this gives you guys a little bit of tidbits, and I didn't ramble on too long. But yeah, if you guys like this kind of thing, let me know in the comments, and subscribe. Peace.